Today is October 1st, 2025, and today's financial markets are buzzing with one of the most significant announcements in recent memory. Two of the largest banking institutions in the United States, Wells Fargo and Chase Bank, have jointly announced a move that is not only historic in its scope, but also potentially transformative in how global currencies may be managed in the future. For the first time ever, these two major private financial institutions have introduced fixed exchange rates for two currencies that have long been associated with high volatility and unpredictable performance: the Iraqi Dinar and the Vietnamese Dong. According to the official announcement, the Iraqi Dinar has been pegged at 5.02, while the Vietnamese Dong has been fixed at 3.94. This decision marks an unprecedented intervention by private banks into the realm of currency stabilization, a role traditionally occupied by central banks, monetary authorities, or international institutions like the IMF.
The response to this announcement has been immediate and intense, with analysts, investors, economists, and government policymakers across the globe all attempting to interpret what this could mean not just for Iraq and Vietnam, but for the broader landscape of international finance. At the center of the discussion are pressing questions. How will Wells Fargo and Chase maintain these fixed rates without the full suite of central banking tools? What reserves will be used to uphold these pegs during times of market stress or economic turbulence? And what precedent does this set for future financial interventions by private institutions? Historically, decisions to peg a currency have come with significant responsibility, requiring meticulous monetary policy alignment, vast foreign exchange reserves, and unwavering investor confidence. So for two private banks to take this step, it implies not only a high level of planning, but also a bold willingness to challenge traditional structures of financial governance. Both the Iraqi Dinar and the Vietnamese Dong have suffered from long-term instability due to a variety of internal and external pressures.
In Iraq's case, the dinar has been vulnerable to fluctuations in global oil prices, ongoing political uncertainty, and limited confidence in the banking system. In Vietnam, while the Dong has fared better in recent years due to a booming manufacturing sector, it has still struggled with currency speculation, inconsistent trade policy reactions, and external dependency on major trade partners. The result has been a long-standing lack of predictability in both markets, affecting not just foreign investors, but also local businesses, households, and everyday citizens trying to budget for daily expenses. By fixing these exchange rates, Wells Fargo and Chase Bank are offering a level of stability that could bring multiple benefits to these nations. For businesses, the advantages are clear. Contracts become more reliable. Import-export planning becomes more.
In Iraq's case, the dinar has been vulnerable to fluctuations in global oil prices, ongoing political uncertainty, and limited confidence in the banking system. In Vietnam, while the Dong has fared better in recent years due to a booming manufacturing sector, it has still struggled with currency speculation, inconsistent trade policy reactions, and external dependency on major trade partners. The result has been a long-standing lack of predictability in both markets, affecting not just foreign investors, but also local businesses, households, and everyday citizens trying to budget for daily expenses. By fixing these exchange rates, Wells Fargo and Chase Bank are offering a level of stability that could bring multiple benefits to these nations. For businesses, the advantages are clear. Contracts become more reliable, import-export planning becomes more manageable, and pricing strategies no longer have to account for major currency swings. For investors, reduced volatility means more opportunities for long-term positioning, portfolio growth, and confidence in market entry. And for citizens, especially in Iraq, where trust in the banking sector has historically been low, this could be a turning point in rebuilding faith in formal financial institutions. Families may find it easier to save, plan, and budget with a currency that maintains its value. But despite these potential benefits, there are significant risks involved. Maintaining a fixed exchange rate is no small task. It requires more than just making an announcement. It requires enormous amounts of foreign currency reserves, usually US dollars, euros, or gold, held in readiness to defend the peg during times of pressure. If, for example, demand for the Iraqi dinar suddenly increases, the banks would need to sell dinars and buy foreign currency to keep the rates stable, and vice versa during a downturn.
This means that Wells Fargo and Chase will have to maintain extremely large war chests of liquidity and foreign currency holdings. In addition, they must be ready to engage in active market intervention at any time, something usually done by central banks that have direct control over monetary policy. In the absence of tools like setting national interest rates, printing currency, or using fiscal levers, these banks will have to rely on a combination of market positioning, interest rate coordination with local governments, and close cooperation with the central banks of Iraq and Vietnam. And it appears they have done just that. According to insiders, this initiative was not taken lightly. It reportedly followed years of planning and months of direct consultation with policymakers, economists, and regulatory authorities in both Iraq and Vietnam. The objective was to ensure that this fixed exchange rate model would not run into conflict with domestic policy goals or cause friction in the broader macroeconomic environment. This level of planning demonstrates just how seriously this initiative is being taken. But even with all of this groundwork, skepticism remains. Critics argue that private banks, no matter how large or well-capitalized, do not possess the same authority or stability as sovereign central banks. If reserves begin to run low due to external shocks, such as a drop in oil prices for Iraq or global supply chain disruption affecting Vietnamese exports, the banks may find themselves unable to maintain the peg, leading to a potential collapse of the system and a loss of trust among market participants. The risk of speculative attacks, where traders bet against the peg in anticipation of a breakdown, is also real. We've seen this before, most notably during the Asian financial crisis in 1997 and the collapse of the British pound from the ERM in 1992. These events serve as reminders that even well-planned pegs can be broken if market confidence erodes or if external conditions shift dramatically. Nevertheless, the upside is equally powerful. A successful implementation of these fixed exchange rates could transform how emerging markets approach currency stability. It could attract new waves of foreign direct investment into Iraq and Vietnam, enable smoother trade negotiations with international partners, and even help integrate these economies more deeply into global financial systems. Iraqi oil contracts, for example, could be priced more predictably, ensuring revenue streams remain stable for both government budgets and private investors. Vietnamese manufacturers could sign long-term deals with greater confidence, knowing that currency risk is minimized. Moreover, the move challenges the long-standing assumption that only governments can or should take the lead in stabilizing currencies. If private institutions like Wells Fargo and Chase can manage this responsibility successfully, it may encourage similar collaborations between banks and states in other parts of the world, especially in regions where government capacity is limited but private capital is abundant. This could represent a new model for monetary partnership, one rooted in collaboration rather than traditional state control. However, execution will be everything. To maintain the peg, these banks will need to demonstrate consistent discipline, transparency, and strategic foresight. They must communicate clearly with markets, provide regular updates on reserve levels and intervention strategies, and maintain tight alignment with the fiscal policies of Iraq and Vietnam. Any hint of mismanagement or lack of coordination could cause investors to lose faith, leading to destabilizing capital outflows or market panic. Furthermore, global dynamics cannot be ignored. Iraq's economy remains deeply tied to global oil markets, which are inherently volatile. A sudden drop in oil prices could strain the country's fiscal capacity, thereby testing the peg. Vietnam, while more diversified, is deeply embedded in global supply chains, making it vulnerable to international trade tensions or economic slowdowns. Both countries must navigate these external threats while ensuring their domestic economies remain healthy and aligned with the fixed-rate policy. In many ways, this initiative is as symbolic as it is practical. It signals a new willingness to innovate within financial systems that are often resistant to change. It suggests that banks are no longer content to play passive roles in global economics, but are stepping forward as active architects of monetary stability. And it highlights a broader shift in financial thinking, one that recognizes the importance of predictability, stability, and shared responsibility in a world that has become increasingly volatile. For the citizens of Iraq and Vietnam, this announcement may seem technical on the surface, but its potential impact on daily life is profound. A stable currency means more than just easier budgeting. It means trust in the value of your earnings. It means confidence when taking out a loan or signing a contract. It means relief from the constant fear of inflation or devaluation. It means building a future with less uncertainty. And for international observers, this moment could mark the beginning of a larger trend. If this model succeeds, other countries facing currency instability may explore similar strategies. The combination of private capital, international collaboration, and local economic alignment could offer a new playbook for financial development in the 21st century. But for now, the eyes of the world are on Wells Fargo, Chase Bank, Iraq, and Vietnam. Will the fixed exchange rates hold? Will this collaboration prove sustainable under pressure? Can private banks truly shoulder the burden of currency stabilization? These questions will unfold in the months and years ahead. What's clear is that we are witnessing a landmark moment in financial history, one that could reshape the rules of currency management, redefine the role of private institutions in public economics, and even spark a new era of global monetary innovation. Whether this proves to be a model for the future or a cautionary tale will depend on its execution, its resilience, and its ability to deliver on the promise of stability in a world that rarely offers it. Either way, September 29, 2025 will be remembered as the day when two private banks attempted to do what once seemed impossible: bring order to some of the world's most unpredictable currencies.